So, very good afternoon, friends. And it's a warm afternoon, and the room is quite chilled. So, as Ravi Bhai said, my endeavor for this next couple of sessions will be to keep you guys excited and active. What I've done is can we take the second session first? That is the EAC opinions, recent EAC opinions, and then common errors we can probably post, tea break we can take. So friends, what I've done is that I have compiled a few EAC opinions. Most of you, I'm sure all of you would be familiar of the EAC, the due process, etc. Before I, start the session, I'll just try to remind you that EACs are, pronouncements of a committee of the institute, the expert advisory committee. EAC opinions, we know that, in various volumes they keep coming. In the journal also they print, they publish. And the EAC, the disclaimer that they give is it's fact specific. So it's a querist specific facts, and the conclusion whatever the EAC committee draws is based on, it's confined to that particular fact pattern. For sure, many a times some of the EAC have a larger implications, because many a times the clarifications that is sought from the EAC is a more general and far-fetching in nature. For example, in one of the case it was depreciation under Schedule 2, whether it is so those kind of things have far-reaching, but fact-specific EAC opinions are the remit of that. It's not a so to say a pronouncement of the institute which is meant for all the members. But one can of course draw the wisdom and the conclusion based on your own specifics, based on your own companies or client specific facts, and can draw an analogy from the EAC that is already there in public domain. So that's about EAC opinions. So how I have compiled a list of EAC opinions, will go through probably 7 to 8 key EAC opinions. What I've done is last couple of years, last 24 months, whatever EAC opinions have been released by the institute, I have pulled out the ones which are not specific to specific to a sector. Many a times EAC opinions, there are many EAC opinions on, for example, service concession arrangements, right? BOT model or gas pipelines, etc., which is very specific, very narrow kind of a thing. And I've selected it based on an assumption that most of the audience in this session would be not focused on specific industries or specific things, but we will focus on things which have general thing like fixed asset, for example, or revenue recognition, or certain financial instruments where whether preference shares, whether they can be classified as equity or liability from an IND AS perspective. So that is the approach that I have tried to follow for the selection of the EAC opinions. Obviously, it's not a comprehensive list. It's just to have this session for about 1.5 hours. I'll go through the EAC opinions one by one, and let's try to keep the session interactive, because I'm sure some of these fact patterns that the EAC opinions have would provoke many thoughts and questions in your minds. And please do feel free to raise your hands and ask questions, because that's how this session will be more interesting. So let me start with the first one. Let's say, and this is again a scenario which we often come across either in our clients or in our company. So let's read this. A Limited is in the business of real estate property development for sale in ordinary course of business. In 2005, an MOU is entered into between A and B, which is another real estate developer, was executed for sale of property after development, salient features of which are as follows. A and B shall take up development by pooling their resources and expertise. A sale of the property, for the sale of a property, a professional marketing agency will be appointed. The marketing expenses or brokerage would be borne by A and B in their respective areas. In order to work out the profit element of the equity of both, the partners shall be deducted from this total sale proceeds. The profit generated from the project, or alternatively the built up space, after working out the weighted percentage based on the report of an agency, would be shared between A and B in the ratio of the equity. Upkeep and maintenance of the property after completion of construction in respect of sales, leasing of the accommodation shall be done jointly by A and B and respective owners with a mutual understanding. What the fact pattern says is, in the past, A has made various attempts to sell the property with appointment of a property consultant, giving advertisement in leading newspapers, attempt to sell it to joint operator, etc. However, the property could not be sold due to non-availability of CC or OC, completion certificate, or OC, occupation certificate, and pending RERA formalities. In order to generate temporary rental income, the property has been let out to government authorities for a short period. A has recently received the OC of the project, and sale of the project will be launched at the earliest after completing the RERA and other statutory requirements. The definition of IND AS 40 states that investment property is a property, land or a building, or part of a building, or both, held by the owner or the lessee as a right of use asset to earn rentals or for capital appreciation, or both, rather than for use in the production of supply of goods or services, or for administrative purposes, or sale in ordinary course of business. IND AS 2 states that inventories are assets held for sale in the ordinary course of business, in the process of the production for sale, for such sale, or in the form of materials or supplies to be consumed in production processes or rendering of services. Intention of the management of A is towards development, the developed property, as demonstrated from the action taken, has always been to sell them in the market and not for letting them out. So the obvious question, there's one more slide which gives the answer that the opinion that the EAC came up with. But based on what we have read so far and the facts, obviously the issue is whether this property should be classified as inventory, investment property, or fixed asset, whatever, right? So based on that, anyone wants to attempt an answer? Yes, ma'am? Why inventory? Okay. So ma'am says that it should be classified as inventory. Any other contrarian views? Yes, sir. Inventory. Any other view? Anybody feels or has sympathy for classifying as investment property? Okay, let's see what the EAC said. On the basis of the above, EAC opined that A's share in the property or the project is in the nature of inventory and not investment property. So absolutely right, because the underlying intention of the company is not to hold it for a long term for capital appreciation or for rental. Whatever on a temporary basis, whatever letting out activity is being done, it is only for the purpose of temporary thing. It cannot be, it's not for a long term, and therefore the facts suggest that the intention of the company is to sell it off, right? So in the in near term, and whatever arrangement is being currently done of letting out is because the RERA approvals, etc., are still pending. So absolutely correct. It should be inventory in nature. Let's move on to the next one. This EAC opinion, friends, deals with determination of normal capacity for the purpose of inventory valuation, for allocation of inventory of production fixed overheads. A PSU company producing iron ore concentrate and pellets was forced to close its mine on 31st of December 2005 due to a Supreme Court verdict. Consequently, the unit now operates solely by producing pellets from the bought out ore. The company valued closing stock by allocating fixed cost based on the average production of the last 5 years as normal capacity. It also includes general expenses, welfare expenses, tender advertisement costs, and adjusted for interest recoverable from employee loans in the inventory cost. The CAG, so since this is a PSU company, the CAG also goes through the accounts, and in its review, the CAG observed that suggested that the normal capacity should reflect the budgeted targets and that certain costs such as general, welfare and advertisement and other income should be excluded as they do not contribute to bringing inventory to its present location or condition. So obviously the question is whether the practice that the company was following, the accounting policy that the company was following of treating the employee cost, the welfare cost, general expenses, advertisement cost as a part of inventory cost, and the income, that the interest income on employee loans, whether that should be treated as a part of inventory cost under IND AS 2. Anybody? क्या लगता है आपको? Is CAG right? Is the company right? What are your views? Yeah. Can you treat general expenses as a part of fixed overhead for the purpose of inventory valuation? Yes, no? No, right? Can you treat welfare expenses as a part of inventory? Now that depends, right? Because if it is an essential cost of bringing the inventory to its current condition and location, then yes, but otherwise no. If it is a cost which is incurred, not for the employees who are, basically your workers or your, wages who are contributing for the inventory production, then it should not be treated as inventory cost. Advertisement cost, वो हो सकता है IND AS 2 में या AS 2 में नहीं हो सकता, right? How about interest recovered from employee loans? Can that be treated as a part of inventory cost? Can it be deducted? No, right? Let's see the answer. The committee noted that staff welfare or general expenses, these are included only if they relate to factory or production unit employees or represent factory overheads incurred in bringing inventory to its present location. Tender advertisement, these are pre-purchase costs incurred to explore suppliers and are not directly attributable to acquisition or cost of purchases. Opportunity cost or interest income, again these are imputed opportunity costs. They are not used for measurement in accounting in any case. Interest recovered from employee is other income and should not be used to reduce inventory cost. So the opinion that the committee gave was For normal capacity, it may be determined using the 5-year average only if it approximates the future expectations. Otherwise, the budgeted production and the current facts and circumstances must be used. Staff welfare should be included in inventory cost only to the extent they relate to production unit employees. General expenses included only if they are factory overheads contributing to the inventory's present location or condition. So clear, straightforward. So whatever the company was doing is not in accordance with the requirements of IND AS 2. I think pretty clear. Anybody has a doubt on this? Straightforward. Let's move on to the next one. This is an opinion that relates to treatment of sale of fertilizers and related subsidies. You know, friends, that in India, fertilizer companies, they get subsidies from the government because ultimately the end user, the end customer are the farmers, and because of which the government requires these companies to sell their fertilizers to farmers at a subsidized rate. And part of the consideration is recovered from the government subsequently by the company. So let's say, for example, if 10 rupees is the value of, let's say, the fertilizers, typically the companies would sell the products to the farmers at, let's say, 6 rupees, and 4 rupees would be recovered from the government at a later date. So here's the fact. Let's say the company operating in the fertilizer segment sells products to the dealers. The company receives government subsidy under the direct benefit transfer mechanism, is only finalized and claimable once the dealer sells the products to the final farmer. The company sought to change its accounting method to reduce the margin volatility caused by frequent, sometimes retrospective changes in the subsidy rates. So as you know, many a times government, whatever is realizable from government, there are changes based on the cost that such companies would incur. Okay, so so one of the inputs to the claims that is receivable from the government would be the cost, the transportation cost, the input cost, etc., which is based on a government policy. So as per the formula that the policy would give, there would be changes, sometimes retrospective, sometimes prospective. The company proposed a split approach to meet the matching principle. So for revenue, recognize the sales to dealers under IND AS 115, but only book a proportionate manufacturing cost. So in my example that I had earlier given, let's say 10 rupees is the value, 6 rupees is what I receive from the dealers, 4 rupees I receive later from the government. So 60-40, right? So I'll just take a hit of cost of goods sold to the extent of 60% when I'm selling the goods to the dealers. That's what is proposed by this company. As far as subsidy is concerned, the company is proposing to recognize subsidy income and the remaining proportionate cost only when the dealer sells to the farmer adhering to IND AS 20. So under IND AS 20, the criteria for recognizing grant is when there is a reasonable certainty of realizing the grant from the government, right? And that is achieved at the stage where the dealer ends up selling the goods to the ultimate farmer, right? So that is when the company proposes to recognize that revenue, that subsidy revenue, and at that point in time 40% of the cost would also be expensed out. Inventory temporarily hold the cost element tied to the subsidy in the inventory until the subsidy is booked. So till the time the subsidy is recognized, that is the 4 rupees is recognized, the underlying, the corresponding or the proportionate cost would be inventorized and it would not be expensed out in the P&L. So this is the idea that the company has come up with. क्या लगता है? Is this something which is tenable under accounting standard or IND AS? Anyone? So I do a split accounting, so to say. What this company is trying to propose is whatever I'm getting part of my consideration from the dealer, part of the consideration from the government, right? So my accounting, to achieve this, so to say, matching concept, I recognize the income that I get from the dealer, the revenue that I get from the dealer at the point when I'm selling it to the dealer. I don't recognize the subsidy. That too I'll get only when the dealer sells it further to the farmers. So I do not recognize any revenue to that extent, but I split the proportionate cost also. I inventorize whatever is the cost proportion which is pertaining to the subsidy in that ratio, and whatever proportion to the income that I'll get from the dealer, that is what I'll take a hit in the COGS. So ऐसे मैं split accounting करूँगा. Is that something which is acceptable under the standards? No. Why no? What matching principle? But they are trying to achieve a matching principle in a way, right? Commercially. So sorry, can you speak up a little bit? Okay. Any other thoughts? Yes. You don't actually control the, so the goods are either you are parted with the control or you have not parted. It cannot be a hybrid, right? So you have fully transferred the control of the goods that you are selling. So you cannot do this split accounting. So let's see what the EAC said. The EAC concluded that under IND AS 115, that is revenue, recognition of revenue at a point control transfers to the dealer is correct. However, fertilizer subsidies do not qualify as a variable consideration under IND AS 115 because they are government grants, not payments from the customers. So IND AS 20 requires that subsidies must be recognized as assets when they are reasonably, when there is reasonable assurance they will be received. This usually occurs at the time of sale to the dealer, provided the receipt is likely based on past experience. So in my example, the 4 rupee that you are entitled to from the government, that you can argue that that is also real, recognizable, provided the receipt is likely based on the past experience. Okay, if you have a precedence that this 4 rupee you have been realizing on a successful basis, then in that case you can accrue for this 4 rupee receivable from government also. You don't have to necessarily defer it. So, so long as you can establish that there is a reasonable assurance. As far as IND AS 2 requirements are concerned, the committee noted that manufacturing costs cannot be bifurcated. Once the inventory is sold to the dealer, the entire carrying amount must be expensed in that period. Treating a portion of the cost as a separate asset or temporary inventory is not permitted. So, as the lady rightly pointed out, that under IND AS 2, there is no concept of partly you have conveyed the, the control of the underlying goods and partly you have retained. You have either fully, passed on the risk and rewards or the control of the inventory, or you have retained it. You cannot have a bifurcation of the inventory which you have sold to the dealer, and you cannot have a separate inventory of the proportionate cost of the subsidy that you have actually already sold to the dealer. As far as changes in rates is concerned, any retrospective or prospective changes in subsidy rates should be treated as a change in accounting estimate under IND AS 8. So under IND AS 8, for accounting estimates, it's a prospective change, right? It's not that it does not accounting estimate change you don't do a retrospective restatement or anything. So it's a estimate change. You do a prospective true up of the changes in rates of the subsidy that you will get from the government. The proposed accounting to defer the manufacturing cost and split the recognition is inappropriate. All manufacturing costs must be expensed when the sale to dealer occurs. Subsidy income should be recognized as soon as there is a reasonable assurance of receipt, which is typically before the final sale to the farmer. So pretty clear. So both of you were correct. Any other thoughts? Any? Yes, sir, please. G. Yes. Yes. Yeah. Yeah. So in that case, what this second bullet point is saying is, so long as the reasonable assurance criteria is met for the part which is receivable from the government, for the subsidy part of the, so to say, the sale consideration, that I can recognize if I have enough historical precedence and based on past experience, I can establish that I have a reasonable assurance. I tick all the boxes of the requirements for getting the subsidy from the government. Many a times that it will be a matter of lot of paperwork, lot of administrative work. So if whatever as of March or before the adoption of the financial statements, whatever I am required to do for getting that money from the government, technically I have eligibility. There is no uncertainty with respect to the eligibility that I have, I'll be getting this. The company would be in a scenario to accrue for that government subsidy in March itself. In fact, since we are talking about this, in the a few years back, there was this issue of this government grant that I'm getting, whether that can be presented as a part of revenue, right? Because if you look at IND AS 20, there's a presentation requirement that government grant income should be presented in a separate line item such as other income. So whether that by definition of that requirement, the presentation requirement is other income. So if you envisage the P&L of this company, the full cost will come in COGS of the inventory. Revenue will be only the revenue of whatever 6 rupees or 60%, which I am selling to the dealers, which I am getting from the dealers. Now this 40% of my income, because of this requirement of IND AS 20, would be presented under other income. So from a gross, EBITDA perspective or a gross profit perspective, it will, it would not present the right picture of my profitability. So there is a little bit of a history to it also, and the same position was there in AS thing. And in fact, the FRRB, the CA Institute's FRRP had in the AS regime, in fact, said that the practice of combining this 40% as a part of revenue is wrong and non-compliant with AS. So many fertilizer companies, many of whom which are listed also, right? GNFC, there is a couple of others also. Earlier they had, had to have this explanation. Some of the times earlier the auditors used to, draw an EOM, etc. The idea was I cannot show the wrong picture of my gross margin, right, from the analyst's perspective. And in the IND AS regime, again, some of these companies came to the EAC seeking clarification on whether I can have this presentation as revenue, or should I compulsorily present it as other income. As a part of that EAC opinions, it's not this opinion. This is not talking about presentation. Presentation is a different EAC opinion, which I have not covered here. But in that EAC opinion, the EAC committee opined that you cannot present it as revenue for sure, because if you look at the first bullet point, here also they are saying that it's not a variable consideration. Because they are government grants. They are not payments from the customer. Your customer is the dealer, not the government, even if you are selling fertilizer under a government scheme, right? So therefore, in this case, in that case, the EAC said that you can present it perhaps as a other operating revenue, but not as revenue. Other operating revenue on the main P&L. Of course, now we are talking about IND AS 18, etc. And I believe earlier you had a session. But today, if you look at Schedule 3, you have revenue and then you have other income. Revenue ka breakup you give in the schedule, where you have sale of goods, sale of services, and then you have other operating revenue. So items which do not get classified as sale of goods or sale of revenue, you can classify it as other operating revenue if they are in the normal course of business or ordinary course of business, right? So under Schedule 3 also there's guidance on what is other operating revenue and how is it different from other income. The guidance note says that it is something which income which is generated through a normal course of business. So long as it's within your ordinary course of business, it can be classified as other operating revenue. So in that case, EAC said that this 40% you can classify it as other operating revenue rather than other income, but don't please combine it as sale of goods. So at least that partly addressed the concern of the companies. They said कि ठीक है, हम other operating revenue में present करेंगे इसको. Yes, sir.
The subsidy portion which has accrued, you want to recognize that. Are you going to recognize the government department as a receiver?
Yes.
In which case, would there be a probability also that you might have to provide for some expected return?
Yes. So the moment there is, so again there is another EAC opinion where obviously in India we know that some of the government dues take painstakingly long time to realize, and one of the arguments that the company had made was, I think I have covered that EAC opinion also, but nevertheless, because it's government after all, the counterparty is government, and it is backed by a sovereign guarantee, there is no delinquency risk. Therefore, based on that argument, can I dodge ECL provision? Can I say that it is government of India or one of the state governments or government agencies that is the party here, and therefore I do not have any delinquency risk, and therefore I will not have any ECL. EAC committee said that cannot be sustained, because in IND AS 109, apart from the delinquency risk, credit risk also encompasses delay risk. So if there's a party which has not defaulted, but always there is a delay in the realization, in that case you still have some credit risk, and therefore ECL should be, in coming back to your question, this receivable from the government should also be subjected to ECL. Now, how you will do is again a very tricky thing, because you will be going by the simple, so to say, the provision matrix, right? The simplified approach. जिसमें basically you will have to figure out the historical trend of historically when you have realized the amount since the point of recognition. That is going to be, so that is again a very tricky thing, because invariably it's dependent on the surplus or the funds that the government of the day is left with, right? There is nothing like के उनको delay करना है या कुछ करना है, उनके budget में रहेगा, उनके पास funds रहेगा, so they will in that particular month they will just pay it off. There is nothing like, there is I mean, one cannot attribute a behavioral trend to that. पैसा है उनके पास, collection GST का ठीक ठाक है, तो they will get the money. So technically the answer, sir, is that ECL you will have to do. How you will do it is something which is much more complex an answer. Okay, let's take this next one. The company which operates luxury restaurants conducts month-long trials before opening new outlets to ensure consistency in food taste, service quality and equipment functionality. So there is a case of a company which operates in luxury restaurants, like a luxury restaurant chain. Before it starts an outlet, a new outlet, it does to ensure food quality, service quality, etc. It does some trial runs before actually commencing the commercial operations. The company proposed capitalizing following cost as a part of outlet's contribution cost, constructions cost, employee benefit costs, that is salaries for staff recruited early to test the equipment, and material cost for food and beverages trial. Do you think it's acceptable? क्या लगता है आपको? So here's a chain of restaurants. Before the company goes live on a particular outlet of its chain, for certain number of weeks it does a trial run, so to say, to test the market, to ensure service quality, food quality, etc., and kitchen gear, HVAC and lighting and all that. So can it capitalize as a part of the fixed asset, property, plant and equipment of the retail outlet, the employee cost, the salaries for a recruit for testing the equipment, and the material cost for food and beverages trials? It's like, let's say if I'm constructing a refinery and there are trial runs, obviously, right, to ensure that the refining is happening properly and the quality is good, the safety is good. In that scenario, generally it is acceptable under accounting standards also that trial run costs are capitalized. Trial runs may span from 3 months to, let's say, 12 months in extreme scenarios. So this querist has probably drawn an analogy from that scenario and said कि ये मैं एक restaurant का chain में operate करता हूँ, मेरा एक outlet जब भी खुलता है, I do all these things to ensure that it is proper. So it is an essential cost. Maybe the company is looking at it as though commercially it's an essential cost of rolling out the outlet. So why should I not be able to capitalize it? क्या लगता है आपको? नहीं? Anybody wants to answer this? Anybody has sympathy for the querist and feels कि ये हो सकता है, capitalize हो सकता है? This is how sometimes clients come, right? ये हो सकता है, ये commercially तो ये मेरा fixed cost है, essential cost of bringing the assets है to the present location. तो क्यों नहीं हो सकता है? क्या लगता है आपको? Anybody who wants to be devil's advocate here कि नहीं हो सकता है ये? Sir, क्या बोलते हैं आप? Can this be capitalized? Guys, क्या लगता है? नहीं? Why not? नहीं? Test equipment will be for all those basically for the interiors. Sometimes you have those nice looking furniture, etc., or sometimes within the kitchen area also. Okay, so sir बोल रहे हैं कि नहीं हो सकता है, कोई बोल रहा है, anybody who's any takers for yes, it can be done, मुमकिन है? मुमकिन है? Why? Okay. ओके, इट्स लाइक अ ट्रायल रन. ये सर जो क्या बोल रहे हैं कि ये एक ट्रायल रन जैसा है जो मैं कैपिटलाइज कर सकता हूँ. तो लेट्स सी व्हाट द कमिटी फील्स. की पॉइंट्स कंसिडर्ड बाय द कमिटी. Unit of measurement. What is a unit of measurement? Let's look at it that way. An outlet is not a single item of property, plant and equipment. Instead, individual items like kitchen equipment, sound systems and leasehold improvements are separate PPE units. So when I capitalize this retail, this restaurant outlet, I do not capitalize it as one single fixed asset, right? As a part of my FAR, my fixed asset register, I have to have different classification, different line items for what are my appliances, my furniture, my leasehold improvement, my let's say furniture, air conditioners, equipments, etc. So firstly the committee said that पहले ये डिसाइड करते हैं कि यूनिट ऑफ मेजर क्या है. यूनिट ऑफ मेजर आर द इंडिविजुअल आइटम्स, नॉट द रिटेल आउटलेट. सेकेंडली, अंडर IND AS 16, costs are capitalized if they are directly attributable to bringing an asset to the location and condition necessary for its intended operation. Right? So the key criteria here is whether it's directly attributable to bring the asset to the location and condition necessary for its intended operation. Thirdly, it said that what is the nature of trials. The committee observed that food trials are primarily for quality control and brand consistency, that is meeting the management standards rather than technical testing of the equipment's functionality. So it's important to figure out that what is being tried. Okay, is it something which is essential for running the equipment or for using the equipment, or if your standards are little bit higher than the other market participants, then is it for observing food trials or your brand consistency perspective. So agar वैसा है, then that is one of the critical things. So the final opinion was that there is a general prohibition that costs related to opening a new facility, including introducing new products or staff training, must be expensed out in P&L. These costs are not essential part of bringing the equipment to their intended location or use. So these should be expensed out. Food and material costs, since these are incurred to achieve a certain level of service or quality after the equipment is already operational, they cannot be capitalized. So basically you are testing whether your service as an outlet is up to the standards of the benchmark that the company has centrally perhaps laid down. And therefore those are not like essential cost for bringing the assets to their existing condition. Staff salaries, salaries for chefs and service staff are operational preparations and must be expensed. The only costs of technicians specifically engaged during the testing phase to resolve technical operational issues, that is fixing a sound system, can be capitalized as those that are necessary to make the specific asset ready for its use. So the only cost that can be capitalized as per the EAC was that the cost of the technical staff to ensure that the sound system etc. is functioning properly. That is, it is fit enough to be used for its, based on the intention of the company. Otherwise, all the other expenses need to be expensed out as cost. You cannot capitalize that as a part of IND AS 16. Any questions? Yes, sir, please. Chemicals, okay. Months, yeah. So, obviously the costs in case of a factory or a chemical factory for the testing phase, the last bullet point, where the technical, whatever costs are incurred to ensure that the equipment or the plant that you have constructed meets the technical requirement is one thing, right? Because there will be some regulatory thing also, that let's say if you have to construct a plant which is compliant with, let's say a European standard or a US regulatory standard. So that is the intention that you have, you are constructing it. So whatever costs that you incur to ensure that those standards are met, because that is the overall purpose of constructing that plant, would be in my view fitting in that last bullet point, where you are basically incurring those costs to ensure that the equipment, the plant, etc. are in that state or are capable of, meeting those requirements. But yes, if it's merely marketable, customer satisfaction kind of a thing, then it will have to be expensed out. Yes, that is fine. So in that case, if the costs are capitalized, the whatever gain or loss that you generate by selling the trial run production, that also has to be capitalized. GST may, you will still have GST on it, but from an accounting point of view, those costs are basically like incidental cost of constructing the plant. So that ideally should be capitalized. So that will be reduced from the construction cost. Yeah, anyone else? Let's take this one. The querist entity is a joint venture power generating company deemed PSUs in Tripura with a corporate office in Delhi. For FY 23-24 audit, the CAG challenged the company's practice of including 18% GST in its lease liability and ROU asset calculations. The company argued that since their output, that is electricity, is GST exempt, they do not get the ITC of on the inputs. Therefore, the GST is non-recoverable cost and should be capitalized in order to avoid misleading investors about lease expenses. So, I'm sure all of you are familiar with how do you set up the ROU asset under IND AS 116 and the lease liability. So whatever lease payouts, mota moti what we do, whatever lease payouts that is contractually agreed with the lessor, you project that, you plot it on an Excel spreadsheet, you present value the payouts based on your incremental borrowing rate. Whatever present value comes, you set it up as a ROU asset, or samne you create a lease liability. Over a period of time, you amortize the ROU asset based on the lease term, and on the other hand, the lease liability interest gets accrued on it on a notional basis, and whatever payouts happen to the lessor, that becomes that gets reduced from the lease liability, right? That's overall, simply speaking, the way we go about calculating ROU asset and lease liability. तो इसमें सिंपल क्वेश्चन है दैट देर इज अ सिनेरियो वेयर दिस कंपनी बीइंग अ पावर जनरेटर डज नॉट गेट income tax, input tax credit for the GST which it pays to the on the lease payments, right? So therefore it's including in the cash flows that it projects, lease payouts that it projects, the lease payments plus the GST, because it's a cost to the company ultimately. तो वो बोल रहा है कि क्या गलत कर रहा हूँ मैं, why CAG is going and saying कि it should not be included. क्या लगता है आपको? नहीं, should not be? Okay. Any specific reason why? Okay. But essentially as a lessee it's my cost. Had it not been for this lease agreement, I would not have incurred the GST cost. I'm just trying to argue from the querist perspective. तो क्या बोलना है आपको? It's an essential cost of entering into lease which I'm capitalizing. Why can't I look at it that way? Agreed, but उसको तो गवर्नमेंट से वापस he will get either an offset from his outgoing GST or he will get a refund. मेरे को तो खर्चा है इसीलिए I'm capitalizing. That can be one argument. Okay, so you are right. So the committee notes that under IND AS 116, the definition of lease payments as payment is the payments made to a lessor in exchange for the right to use an underlying asset. IND AS 37 categorizes GST as a levy, a statutory obligation imposed by the government, not a payment for the use of an asset. Institutes educational material specifies that lessors act merely as a collecting agent for the government, and thus GST is not a lease payment. So the opinion was that the committee concluded that GST payments cannot be included in the measurement of lease liabilities or ROU assets. This is because GST is a statutory levy paid to the government and not a consideration paid to the lessors for the assets use. Even if GST is non-refundable, as in this case, it must be excluded from IND AS 116 measurement and instead be charged to P&L when the transaction occurs. So you are right. Basically, the committee said that what is a lease payment? Whatever payment is made by the lessee to the lessor, right? This is not a payment that the lessee makes to the lessor, but it's a government levy. And in fact, in IND AS 37, it gets scoped in as a part of levy. There's an appendix which deals with levies, and GST is an example of a levy. So, and then also from the perspective of the lessee, it is just a via media, right? It's just like a pass-through. I collect the money I pay the GST on the lease, and that is an extra cost for me. So because of all this, even if it's not a refundable scenario, it's not a normal scenario, it must be excluded from IND AS 116 measurements and instead be straight away charged to P&L when the transaction occurs. So absolutely correct. You cannot set up an ROU for the GST element of the lease payout, even if it's not refundable. Clear, everyone? Any questions? Yes, sir.
Thinking on the other line, let's say something which is a block, for example, purchase a motor car, there's a GST on it. Will it be capitalized as an
So,
even that dealer is also acting as an agent?
so whatever GST you have paid while purchasing a motor car, while taking a motor car on a lease,
No, not on a lease, I'm purchasing it. I'm buying it.
so in that case, this 116 will not be applicable.
No, in context of IND AS 10,
In IND AS 16 mein any incidental cost is capitalized.
incidental
Yes, yes.
taking the same logic here.
No, there the logic is that you capitalize cost whatever is essential to buy that car. So GST is something which is incidentally incurred to buy that car.
It is an incidental GST.
It's a
Right over this using of this asset.
no, under IND AS 116 what you capitalize? You capitalize only the lease payouts which the lessee, as a lessee you pay out to the lessor. That is what gives you the right. Now whatever is incidental to it,
As a lessee, if I make a payment without GST, that asset is not for me to use.
correct. So that is not a essential cost of the right. What is the right? What I capitalize is not the underlying asset, it's the right to use the asset. अभी वो right to use the asset के लिए मैं whatever I am paying to the lessor is what I capitalize as per the requirements of 116. Whatever government levies are there, that should be expensed out as per that. Because that's something which is not what is entitling me to use the, get the right of the use of the asset. That is my incidental extra cost to use that, have that right. That I cannot capitalize because already I have a liability in the form of lease liability, which is towards the lessor. So over and above that, I cannot capitalize anything. That's more like, a government levy, which I have to expense out in normal course. So in that sense, had the company outright bought this, asset and would have been in the scope of IND AS 16, then in that case you would still capitalize it. But if it's a lease model, then it would be a P&L hit. The GST part would be a P&L hit. This is again a very common scenario these days. So A Limited has allotted 8% CCDs aggregating to 2000 crores. The second bullet point should be CCDs and not CCPS. CCDs are converted into such number of equity shares based on the fair valuation of the equity shares at the date of conversion. Considering the facts that the shares are compulsorily convertible, these have been classified as compound financial instrument under IND AS 32 with the obligation to pay the interest at a coupon interest rate as financial liabilities and the conversion option as equity component. Is the company's accounting appropriate? What do you guys think? जी बोलिए sir, please. You are completely? Okay. You? It is convertible, na? Okay. What is fixed for fixed? Okay, but it is at the time of conversion, at the date of conversion, it will be fixed, na? Anybody else? Anybody else who feels that this should be compound instrument or equity instrument? Commercially, though, it's all, I'm not going to be settling these debentures by paying off money. So why should I not call it as equity or part equity? क्या लग रहा है आपको? Everybody agrees with sir कि ये liability fully liability होना चाहिए? Yeah? Okay, let's see the opinion. The committee noted that the appropriate classification as a financial liability, equity or combination of both is determined by the entity when the instrument is initially recognized. The exceptions in IND AS 32, paragraph 16A to D do not apply in the extant case. IND AS 32 defines the an equity instrument as any contract that evidences a residual interest in the assets of an entity after deducting all its liabilities. While classifying a financial instrument as a liability or equity classification is appropriate only if the instrument fails the definition of a financial liability. In order for an instrument to be classified as an equity instrument under IND AS 32, it is not sufficient that it involves the reporting entity delivering or receiving its own equity instruments. The number of equity instruments delivered and the consideration from them must be fixed, that is fixed for fixed requirement. Contracts that will be settled other than by delivery of fixed number of shares for a fixed amount of cash do not meet the definition of equity. An entity may have a contractual obligation to deliver a number of its own shares or other equity instruments that varies from, so that the fair value of the entity's own equity instruments to be delivered equals amount of contractual obligation. Such a contract is a financial liability even though the contract must or may be settled through delivery of entity's own equity instruments. The number of own equity instruments required to settle the contract will vary. The contract will therefore not fulfill the requirements of an equity instrument and is therefore a financial liability. Interest is payable to the investors by the company as per the terms of CCD would meet the criteria for financial liability classification. Since there is an obligation to pay cash that the issuer, the company, cannot avoid interest payment obligations. For this component, on a standalone basis, there is no feature that is similar to equity. The CCDs are convertible only in the hands of the sponsors at the end of the tenure, or a buyout option or exercising of put options by the investors, and the company would be required to convert the same into equity shares of the company, ranking pari passu with the existing shares at the time of conversion in the same proportion of shareholding or backstop support by reckoning share price at the time of as per the cost conversion formula defined in the transaction documents. The conversion option shall be effective on the exercise of accelerated buyout option, the mandatory buyout option or the accelerated put option, giving the sponsor or nominee an unilateral right to convert the debenture into equity of the company. In the extant case, there is no contractual obligation to pay cash that the issuer, the company, cannot avoid, since the conversion into own equity share is compulsory. However, the conversion ratio for the purpose of the conversion shall be dependent on the share of the company at the time of conversion. So, the final opinion all in all, the committee said that the equity conversion features can only be settled through the issue of equity shares. However, there is an obligation to issue variable number of shares. The number of shares to be issued is based on the share price on conversion. In other words, the conversion price and hence the conversion ratio of the CCD into ordinary equity shares of the company is not fixed at the point of initial recognition of CCDs. Therefore, the conversion component of the equity instrument would not meet the criteria laid down in IND AS 32 for the purpose of classifying as equity. Accordingly, overall the CCD do not meet the criteria for being classified as a compound instrument, as there is no equity component. The CCDs should be classified as financial liabilities in entirety. The accounting treatment of CCDs issued by the company as compound instrument is not in line with the requirements of IND AS 32. The disclosures in the financial statement shall be provided based on the classification as financial liabilities. So absolutely correct, sir. This is not a fixed for fixed criteria, because at the time the debentures are issued, the CCDs are issued, the ratio is not known, it's not fixed, right? Even if it is fixed in a formula which is derived on the valuation at the time of conversion, that vitiates the fixed for fixed criteria under IND AS 32, and therefore this instrument cannot be treated as equity fully or partly. It is entirely a financial liability under IND AS 32. So absolutely correct. In fact, practically we see, many companies coming up with IPO issues. Now, whenever there is a private equity funding in the company, most of the cases it will, if you go through the the finer points of the investment term sheet or the investment agreement, you will find such anti-dilutive provisions or any IRR which has been committed by the company, by the issuer company, which in most of the cases would lead to a financial liability classification from the company, the issuer company's perspective. So please be very careful when you have a scenario where an investor is funding a company and there is a CCPS or a CCD kind of an instrument where the company would benignly come to the you saying that this is convertible compulsorily, right? So this is equity. So where is the question of any financial liability classification? Sometimes it's difficult to enlighten the businessmen the requirements of IND AS 32, but this fixed for fixed criteria is something that has to be carefully looked at, and especially if the company is going for IPO, and if the classification in the balance sheet of financial liability and equity itself is wrong, then fundamentally the in the DRHP thing, the regulators would be also getting very skeptic about the auditors and the company also. So this is something which, wherever there is a private equity or any other investor also for that matter, and it's not a pure play equity, it is some of these instruments, please be careful as practitioners whether the instrument fulfills the requirements of IND AS 32 to be called as equity. Yeah. Any questions on this? But I think you got it absolutely correct, sir. It's fixed for fixed criteria. That is not met. Should we go to the next one? Yeah, this is what आपने सर जो पूछा था, ये इसका EAC है. So question is whether any exemption is available for making provisions for ECL under IND AS or other guidelines issued on the date where the clients are central government, state governments, or autonomous bodies or PSUs, as per paragraph B5.5.35 of IND AS 109, permits use of practical experience when measuring ECL if they are consistent with the principles of paragraph 5.5.17 of that standard reproduced above. Paragraph B5.5.35 of 109 cites calculation of ECL on trade receivable using a provision matrix as an example of practical expedient. Impairment requirements of 109 are mandatory. In particular, receivables arising from application of IND AS, it should be 115 now, if measured at amortized cost, are subject to impairment requirements of 109. No exemption is given in IND AS 109 from compliance with impairment requirements of that standard for any entity. No exemption is available for making provisions for ECL under IND AS or other guidelines for where the clients are central government, state government, or autonomous bodies or PSUs. So very clear, the EAC opinion stands that even if the counterparty is a government authority, still because of the requirement in 109 of factoring in delays in realization, ECL is something which has to be done. There is no exemption, en masse exemption for government customers. Let's take this. Yeah, I think we have time for a couple of more EAC opinions. A Limited has adopted residual value of an asset at 5% in line with the industry practice. The company charges depreciation on its property, plant and equipment over 30 years, which is as per the requirements of Schedule 2. After keeping 5% towards residual value, which is as per Schedule 2 and industry practice. Under IND AS 16, the residual value of an asset is the estimated amount that an entity would currently obtain from the disposal of the asset. After deducting the estimated cost of disposal, if the asset were already of the age and in the condition expected at the end of its useful life, the residual value of and the useful life of an asset shall be reviewed at least at each financial year end, and if expectations differ from previous estimation, the change shall be accounted for as a change in accounting estimate. There's a guidance note that the institute has issued on accounting for depreciation in companies in context of Schedule 2, where basically it has given this diagram where there are three sources or three types of disclosure requirements for residual value. If it's lower than 5% of the original cost, then there are no disclosure requirements. If it is equal to 5% of original cost, then you have to disclose. Again, there are no disclosures. If it is higher than 5% of the original cost, you have to make disclosures of how did you get to a residual value of higher than 5%. So basically here the company's accounting policy to keep standard residual value of 5% without considering all the facts and circumstances is not appropriate. The company should determine residual value of its various pipelines considering the facts and circumstances at the beginning of their useful life, which should be reviewed at least each financial year end. Further, the estimated cost of disposal should be considered as per the definition of residual value given in IND AS 16. In the case the benefits from the assets will not be extracted and will just be abandoned, the residual value should be considered as nil, as nothing can be sold as scrapped or otherwise. Further, in case it is estimated that the pipeline will be extracted or sold, and the cost attributable to extraction activity should also be considered or adjusted. So whatever incidental cost of scrapping the fixed asset, the old fixed asset, that should be also included and factored in the estimation of residual value as per IND AS 16. Let's go to the next one. A Limited is a leading steel making company in India. At one of its integrated steel plant of A, an order was placed for setting up a blast furnace on a turnkey basis at a contract value of around 1,217 crores. The duration of the project was 30 months from the date of the contract. The date of commissioning was significantly delayed. The querist has stated that the delay was attributable to the contractor and A demanded liquidated damages for delay as per the terms of the contract. The price variation was paid to the contractor for the scheduled period only as the price variation is not payable for the period where the delay is on account of the contractor. The contractor did not accept the delay, rather they had raised various claims on account of extra work or price variation or prolongation cost and interest, etc., which could not be mutually resolved. A invoked arbitration under ICC or International Chamber of Commerce in 3 cases as listed below, and the arbitral award was against A in all the 3 cases. The arbitral awards were challenged by A in the Honorable Delhi High Court. Meanwhile, a committee of senior officials was constituted for a mutual commercial settlement. After arbitration was invoked by the contractor, the additional amount claimed by the contractor was shown under contingent liability until FY 21-22. Amount paid by A towards extra price variation claims, extra civil work, additional design engineering cost was capitalized. So basically the question was whatever additional claims that were received from the contractor by this company, whether it can be capitalized as a part of the cost of fixed asset by this company. Let's see the answer. IND AS 16 requires only those costs or expenditure that are directly attributable to bringing the item of PP to the location and condition necessary for it to be capable of operating in the market intended by the management should be capitalized as a part of the cost of PP. An item of PP shall be measured at recognition at cost, which is in the extant case includes an element of an estimate towards extra price variation claim, extra civil work and additional design engineering cost at the time of capitalization of the asset. Subsequently, the actual cost of which got crystallized at a higher amount, and therefore the same is a change in the estimate in the cost of the PP, which should be accounted for as a change in accounting estimate as per IND AS 8. A change in estimate due to the adjustment of the carrying amount of an asset should be recognized prospectively by adjusting the carrying amount of the related asset in the period of the change. Therefore, the additional amount incurred towards the cost of the asset due to change in the initial estimate of the cost of the asset arising because of the settlement of the provision or liability towards design engineering cost, extra civil cost and price variation claims, etc., should be capitalized with the cost of PP or assets prospectively. So basically whatever changed in the claims that the contractor had to be paid is a change in the accounting estimate. So further, the depreciation amount on the amount capitalized subsequently due to the change in the estimate should be charged prospectively. So you cannot change last year's depreciation for this, but for the part which you have subsequently capitalized, the depreciation, the useful life should be adjusted accordingly. So if your total useful life for the plant was, let's say, 30 years, and 2 साल बाद आपको ये change आ गया. So for depreciating that, the useful life that you should calculate is of 28 years, right? So it should not be prospective. And also because there has been delay, etc., it's an impairment trigger under IND AS 36. You need to also test the asset for impairment. Any doubts on this? Any questions with respect to this? I think that was the last EAC opinion that I wanted to touch upon. I'm not sure if tea is ready, but yeah, it's ready. You're sure? Okay, so then maybe, unless you all have any questions, let's break for tea. In any case, even in the next session which I am taking, if you have questions, happy to take them. But maybe we can spend 10-15 minutes and we can meet post tea, maybe at around 3:15 or thereabouts. Session, we'll go through some of the common errors that is generally seen in the financial IND AS financial statements. For this session, the way I've compiled the slides or the points is that basically many of you all would know, or perhaps all of you all would know, is that there is a financial reporting review board, FRRB, of the CA Institute, which on a constant basis looks at the financial statements which are within the ambit of, in fact, it also looks into the listed companies' financial statements, and on a no-name basis it comes up with its findings. Basically, the objective is to have a general awareness amongst the practitioners and the companies of what are the fatal flaws of financial reporting. If the FRRB, in some cases, if they conclude that the financial reporting is absolutely off the mark, way off the mark, and therefore basically the true and fair opinion or the basic figures that got reported as profits or as shareholders' equity by the company is itself not entirely correct, then in those cases, those are like extreme cases but happens quite often these days, then in that case they issue an advisory to the specific member in question and the auditor, the statutory auditor, and then there is a request to submit the responses and all that. So it's something which has been going on since a long time. FRRB has been in place for a fairly long time. Of course, now in last few years, we know that NFRA has also become one of the serious regulators of India, and they also in turn look into, they issue something called as FROR, FROR, that is financial reporting. I forgot the full form of the acronym, but they have a process of looking at a quality, financial reporting quality review or something like that, FRQR. So they also come up with some things, such things, but ever since NFRA has come into picture, FRRB has started becoming more active, and this advisory that I mentioned, that if the reported figures are apparently questionable, then they do get into that thing. Sometimes fines are also levied on the chartered accountant from the company, the CFO or one of the members, and also the auditor who has signed off on the financial statements. So what I've done is for this session I have picked up some of the emerging themes in various standards. I have also chipped in some of the NFRA ones, not that NFRA has significant, so of course NFRA in some cases unfortunately has also come across instances where listed companies have not published their statement of changes in equity etc. किसी को पता नहीं था, balance sheet and P&L and cash flow ही sign हुआ, SOC तो बनाया ही नहीं, and they are listed companies, right? So those are like very fundamental and elementary errors. So I'll not get into those kind of things, just to have a good session. So in that case, so I've structured it standard by standard. So as in case of last session, please do try to keep it as interactive as possible. We'll have, so if you have any doubts or any questions, please feel free to ask them. We start with the standard, the most common standard which gives common this errors is with respect to property, plant and equipment. The FRRB keeps coming up with instances where it finds that there's inconsistency between the opening balances and closing balances year on year, not just the fixed assets, the property, plant and equipment figures, but also the capital work in progress. CWIP, as we know, apart from the requirements of IND AS 16, there are more disclosure requirements coming up from Schedule 3, where you need to give project-wise bifurcation of the CWIP, the aging analysis, and also either there are any time overruns or cost overruns in any of the capital work in progress projects, then in those cases those should be also disclosed. So it's a standard boilerplated table that Schedule 3 gives, and that's something which needs to be furnished. FRRB also came across instances where property, plant and equipment pledged as security was not disclosed. IND AS 16 does have a requirement on whenever there is an asset which is offered as a security or a pledge for a borrowing or a loan, in that case that fact should be disclosed कि कौन से assets have been offered for security, and generally we find that either as a part of the the borrowing disclosure, borrowing schedule, or the fixed asset schedule, but that's something which needs to be carefully disclosed. And apart from the shareholders and stock exchange, also from the bank's perspective, the lender bank's perspective, it becomes a important disclosure. Insurance claim on PPE netted off with loss instead of showing compensation when receivable. Again, this is a fairly old practice which the FRRB has never endorsed, that when there is an insurance claim that the company gets or is expecting to get on account of loss by fire or by accident on fixed assets, on property, plant and equipment, the presentation is the claim is netted off from the loss amount. The standard, the IND AS 16 standard as well as IND AS 37 standard for that matter, requires the presentation to be on gross basis rather than on net basis. Then there is impairment testing of assets was not conducted as required under IND AS 36. Under IND AS 36, for property, plant and equipment, or for that matter on any non-current asset, that is let's say your fixed assets, intangible assets, investment property, or CWIP, or intangible under development, there is a requirement that whenever there is an indicator, impairment indicator, so impairment indicator would mean, say for example, if there is, let's say, a war which has now broken up into say West Asia, and if there is a plant, there's a factory which caters to exports predominantly to, let's say, Iran or say West Asia, which is affected adversely. As of 31st of March 2026, there would be an impairment indicator because of this external uncertainty, so to say, and therefore one has to do a impairment testing. So that will be one of the things. So in this case, FRRB stumbled on a scenario where the company did not do adequate impairment testing while there were indicators in place in minds of the FRRB. Of course, for goodwill and for intangibles under development, even if there are no impairment indicators, but you need to, on an annual basis at least, you need to compulsorily test goodwill and intangible under development for impairment. So uske liye you don't need to have a trigger for impairment. By default you need to test it for impairment, and there are hell lot of disclosures under IND AS 36 also, wherein you need to give a CGU wise breakup, you need to give the sensitivity analysis, the headroom disclosure, the key assumptions, methodology followed, and so on and so forth. So IND AS 36 disclosures are quite onerous, and one has to carefully look into that. In case of one of the companies, the FRRB found that the PPE accounting policy was as follows: subsequent expenditure related to an item of property, plant and equipment is added to its carrying value only if it increases the future benefits from the existing asset beyond its previously assessed standard of performance. So here again, although prima facie this accounting policy looks fine, but because there is a requirement under IND AS 16 that if it's not just increase in future benefits of existing assets, but if it is the subsequent the subsequent recognition criteria is also, so because IND AS 16 follows this component approach, the requirement is the moment you have a subsequent expenditure on a property, plant and equipment, you de-recognize whatever was earlier recognized, but it is replaced in this process, and you capitalize the new one. So that policy did not come into, it was not disclosed, and therefore this policy seems to be based on the old version of AS 10 that this company had given. Similarly, one other company had provided this disclosure of its accounting policy: depreciation of leasehold improvements is provided over the primary period of lease or over useful life of the respective fixed assets, whichever is shorter. What is wrong with this accounting policy? Anyone? Last one. So here basically it should be the shorter of the lease life of or the useful life, but it is the leasehold improvements cannot have a high, longer useful life than the lease life. So it should be depreciated on an accelerated basis. There was a company which did not amortize leasehold land. Under IND AS 16, leasehold land is not, leasehold land generally would mean that there is a ROU asset. It's not IND AS 16, it's a IND AS 116 subject matter. when you have taken a land on on lease basis, it will be a leasing arrangement which will be under the scope of IND AS 116. You need to set up a ROU. Most probably you may not have lease liability, or you may have a very small figure of lease liability. But essentially the leasehold land should be amortized over the lease period. In some cases, again, there was earlier a EAC opinion where it is extendable at the option of the company, where there is a very long-term lease of a land, let's say for 98 years or somewhat like that. Then in that case, you can classify it as a property, plant and equipment, but you need to disclose that this is on a leasehold basis. You still cannot say that this is freehold land. No movement of or reconciliation of capital work in progress. So a company presented PP and CWIP as separate line items on face of its balance sheet, although there was movement in the balances in the current year and previous year, no disclosure in capital work in progress was made. So this is a scenario where although there was CWIP, but that movement as per the requirements of IND AS 16 and Schedule 3 was not adhered to. Expenditure during construction period was not disclosed. IND AS 16 does require a disclosure of expenditure during construction period before the capitalization of the fixed of the property, plant and equipment. Depreciation method or rate not disclosed, whether it's SLM, whether it's WDV, and the useful life was not disclosed. Inconsistent opening and closing balances year on year. I mean, this is very like clerical or a very basic kind of a thing. In the note of the financial statements on property, plant and equipment, previous year figures were not provided for all the items. Comparative disclosure is compulsory under IND AS 1, as also in Schedule 3. In one case, the accounting policy on PPE states as follows, that is property, plant and equipment, assets not owned by the company are amortized for a period of 10 years. If you don't own the asset, then perhaps you have got it wrong. You cannot call it as property, plant and equipment. Right? So in that case, it can either be a prepaid asset or some different type of deferral, but it can certainly not be a property, plant and equipment. So that was one of the error that the FRRB found in one of the balance sheets. Any questions on this so far in IND AS 16? Pretty straightforward. Yes, please. Yes, sir. If any asset is held by the so if it's in the name of the company, if it's not in the name of the company, ideally you should not capitalize it. You may have the registration in the company's name, and the RC book may still have the company's name, but it may have the RC book is generally a natural person, so you may have the director's name. That is acceptable. But if the registration is in the director's name, then basically it's a loan that the company has given to the director to buy a car. Then in that case, ideally it's a more of an advance rather than, or a loan rather than a fixed assets in the books of the company. I know in some of the private companies this is a practice that we come across. Yeah, so that disclosure is fine, that is, and you are right in giving that disclosure. But to call that fixed asset as that car as a company's property, plant and equipment, and even in income tax, it will be difficult to claim the depreciation of the on such in such cars on such cars. Because the moment it is in the name of the director, I'm pretty sure, and especially when you have this disclosure in the financials and in your Caro report and all that, the tax officer, it will be a very easy thing for a tax officer to disallow the depreciation, and in fact say that this is basically a perquisite in the hands of the director. But that's a good point, and it is a very common thing actually. So then, but technically it should not be classified as property, plant and equipment unless the car is subsequently, there is some arrangement between the director and the company to convey the property of the car in the name of the company. So again, there will be some GST exposure on that, but yeah. But if it's not conveyed in the name of the company, ideally it should not be capitalized as property, plant and equipment in the company's balance sheet. Moving on to intangible assets. IND AS 38 deals with intangible assets. Basically, there is so as in case of AS 26, IND AS 38 also has pretty strict criteria when it comes to capitalization of development cost, and whether the expense that is incurred is in the research phase or in the development phase. There are some 6 criteria that have to be fulfilled in order to capitalize the development cost as intangible assets under development. And that accounting policies, for example, many pharma companies who are into research, they may have significant intangible assets under development. But the critical accounting policy is the one which distinguishes between the research phase and the development phase. And in the accounting policy, you need to articulate those criteria properly as to what is development and what is a research. Research is not capitalized, it's expensed as incurred. So this is one of the things, that there was no clear disclosure of the capitalization criteria. Again, here reconciliation of opening to closing of intangibles and intangibles under development was a missing thing. Impairment on intangible assets were clubbed with property, plant and equipment. Whether intangibles are internally generated or acquired was not disclosed. There is a IND AS 38 disclosure requirements which requires you to distinguish between intangibles which are self-generated or internally generated and which is acquired. The criteria for capitalization of internally generated intangibles is much stricter as compared to what you have purchased, right? So the requirement is that internally generated, whether it gives a rise to additional economic benefits, whether the cost can be clearly distinguished and determined and attributed to the intangible assets under internally generated, those things are very critically looked by the standard. Similarly, amortization method, and as we saw in case of IND AS 16, amortization method and useful life were not disclosed appropriately by the company. And again, intangible assets, useful life, many a times companies do miss out in the disclosure. Any questions on this, IND AS 38? Okay. Coming to investment properties, classifying non-qualifying investment items like furniture, office equipment, plant and machinery as investment property. Under IND AS 40, can you have, let's say, your furniture or your office equipment as investment property? So let me give you a scenario. Let's say, for example, you have all these business centers these days, right? So WeWork, Quest, etc., co-work spaces, right? So they predominantly lease out their spaces. They have, sometimes they are like ready to move in. So they have ready-made furniture and coffee machines and all that. Which part of that will be investment property? Which part of that will not be investment property? Can it say that the entire facility or the entire floor, including the furniture, the office equipment, the ACs, the coffee machines, etc., everything is investment property because I am renting out the entire thing? Can I say that? Because I am holding everything for rental. Capital appreciation to shayad nahi rahega, but everything is for rental. So by virtue of that, can I classify the entire package or the entire asset as a investment property? Anybody? Yeah? कर सकते हैं? नहीं कर सकते हैं? Yes? Is it correct? So the definition of IND AS of investment property under IND AS 40 is confined to just the building, land or both. So anything apart from land or building cannot be classified as investment property because it has to be essentially real estate property. But having said that, if something is incidental to the building, so for example, if let's say there is this building, right, and there is a lift, right, अभी वो lift को तोड़ने की ज़रूरत नहीं है. If lift is a consequential asset, it's an incidental asset and not the main asset, in that case you can capitalize lift as a part of investment property. However, if you have furniture, let's say if you have nicely done a floor and you're letting out the entire floor, but you have some furniture, some office equipment, that you cannot classify as investment property. That will still be a property, plant and equipment. Mind you, from a profitability point of view, both assets have to be depreciated. So from a measurement perspective, कोई फर्क नहीं पड़ता. But it's from the presentation perspective as to what is investment property, what is property, plant and equipment. So this is a common error that the FRRB found, that non-qualifying items do sometimes get classified as investment property. Missing fair value disclosures, rental income, depreciation method, useful life, and because we are talking about mainly real estate assets when it comes to investment property, IND AS 40 does require a significant, fair value disclosures, the fair value of the, so even if from measurement perspective, you cannot use fair value, it's still cost minus depreciation. But for disclosure, you need to disclose the fair value method, the fair value assumptions, key inputs to fair valuation, any delta from last year, etc. Those disclosures are there. Apart from that, you have the depreciation method, the rental income, directly operating cost for running the investment property. Those disclosures, some of the companies did miss out on, and that was one of the common errors that the FRRB found out. Also, in one case, there was lack of clarity in disclosure of classification when property has dual use. That is inadequate assessment or documentation when a property is partly owner occupied, partly held for rental or capital appreciation, leading to incorrect classification. And this often happens in case of group companies, for example. So I'm sure you would have so all these corporate offices, right, corporate buildings where the entire building belongs to a group, let's say. But the ownership of the building may be vesting with one company, maybe listed, maybe unlisted, and certain floors would be earmarked for certain companies, group companies, and there will be a rental arrangement. So the question is, this is like a dual purpose building from the point of view of the owner of the company which is owning the asset, the building. For the floor that it's occupying for its own people or for its own purposes, it becomes that floor becomes property, plant and equipment. For the one which it has leased out to other group companies, it becomes investment property. So in this case, the FRRB found out that wherever there are such dual usage, the classification criteria is inadequately disclosed. And this is again a very common scenario, and sometimes we do, in fact, oftentimes we stumble upon such scenarios where part of the asset, sometimes it's part of the floor also, right? Half the floor is company A, half the floor is company B. So how to segregate? It can be based on the area, square feet. It can be based on some other criteria. At times it can be based on cubicles. How many cubicles are allocated, or meeting rooms are allocated to the other company. So that classification is judgmental, but it needs to be disclosed as in case of any other accounting judgments or management judgments, right? So it's sometimes becomes very important disclosure. IND AS 105, non-current assets held for sale and discontinued operation. So charging depreciation or amortization after classification as held for sale and not providing for disclosure. So the moment under IND AS 105, a non-current asset is classified as held for sale. There are certain triggers and initial trigger events which the standard sets out, post which you classify it as a non-current asset held for sale. That is, it's classified as a third category, neither non-current, not current, but a third category separately on the face of the balance sheet and P&L. So once you do that reclassification, depreciation, the standard says that if there is any depreciable asset which is part of the disposal group, uska depreciation should stop immediately. And every balance sheet date you test it for impairment, right? So in this case, the company was wrongly charging depreciation or amortization on the asset that it had disclosed as held for sale. Further, there was no disclosure in single line analysis. So once you classify a segment as a discontinued operation, okay, till the time it's entirely disposed, it becomes a discontinued operation. So you collapse, so you don't present the revenue, the expense, the depreciation, the interest cost, etc. of that segment. You collapse it in one line item and separately present it on face of the P&L as income, net income from or net loss from discontinued operation. So this single line compressed analysis was not provided. Likewise, you also segregate in the cash flow statement the cash flows that are originating from the discontinued operation. That becomes, a separate line item. The breakup of that still needs to be presented in the schedule, right? Discontinued operation ke note mein you need to give the breakup. Revenue kitna hai, cash flow from investing activity kitna hai, operating kitna hai, financing kitna hai, etc. And also the EPS from discontinued operation needs to be separately presented and segregated from EPS from continued operation. So that was missed out in certain case. In one of the companies, when it comes to borrowing cost, the policy was borrowing cost directly attributed to the acquisition of fixed assets are capitalized as a part of the cost of asset up to the date is put to use. The asset is put to use. Other borrowing costs are charged to the statement of profit and loss account in the year in which they are incurred. So, is this policy correct? ये सही है क्या? Whatever that has been quoted in the first bullet point, is this policy compliant with the requirements of IND AS 23? क्या लगता है आपको? Okay. So rightly sir has said that it should be acquisition of qualifying assets and not just fixed assets. That is a correct point. Anything else? Sorry? Exactly. So the second thing is, rather than put to use, it should be ready to use. So there are two problems in that accounting policy. First is acquisition of qualifying assets. Separately, the definition of qualifying assets needs to be articulated in the accounting policy. And apart from that, the date up to the point to which it should be capitalized is not put to use but ready to use. And we all are familiar with the distinction between ready to use and put to use, right? That was very, in the CA curriculum, it's very, often asked question. Capitalizing during the project suspension, again, if there is a suspension of the activity of the capital assets, of the qualifying asset, during the course of that time, any cost should not be capitalized. It's a sunk cost. It's a wasted cost. It should be charged to P&L. Capitalization cost on non-qualifying assets like investments or land assets. So again, the identification of qualifying assets. Qualifying asset is any asset that takes significantly long time to either acquire or to build, right? So you cannot have a financial instrument as a qualifying asset, nor can you have any land advances as a qualifying asset. So that cannot be. Your interest on acquisition of investments or land advances cannot be capitalized. No disclosure of capitalized amount or capitalization rate. So whatever interest you have capitalized or borrowing cost you have capitalized during the year, that needs to be disclosed in the schedule. कि कितना आपने capitalize किया है. Borrowing costs were incurrently capitalized as a part of assets cost even after the asset was put to use. So even subsequently, the company continued to load interest cost on the asset, on the qualifying asset. Any questions on this? Straightforward. IND AS 103. Again, IND AS 103 disclosures are quite onerous. Any acquisitions that happen, the consideration, the purchase price allocation, the goodwill, the contribution of the business in the top line in the profits post the date of acquisition, contingent consideration, earnouts, lot of disclosure, contingent liabilities acquired. If there's a goodwill, then what are the source of goodwill or synergies that it will achieve. So there are significant disclosures in IND AS 103, friends. So this is whenever you have come across a client which has acquisition under IND AS, please be sure that you have a very careful look at IND AS 103 requirements for disclosures. And many a times, because of this purchase price allocation requirement, you may need, an expert service, or you may need some, good valuation inputs for meeting the disclosure requirements. Annual impairment testing, we discussed about that. Inventories in certain cases were valued at cost only, or cost or market value instead of lower of cost and NRV. NRV is in some cases was not computed correctly. That is, the cost to complete or sell was ignored, not considered for estimating the NRV. Some of the other expenses like legal, demerger, advertising, etc. were inappropriately capitalized into work in progress. Cost formula like FIFO, weighted average, was not disclosed. So again, inventory, IND AS 2 disclosure are pretty straightforward, but usme bhi some of the companies have made mistakes, and as you can see on the slide. Again, IND AS 115 disclosures can sometimes be very onerous. Missing disaggregation, so revenue disaggregation requirement, disclosure requirement is there, where you need to break up the revenue based on segments or geographies. contract balances need to be bifurcated. The movement of contract balances, contract assets and contract liabilities need to be reconciled. Significant judgments need to be disclosed when it comes to, let's say, if there is a variable consideration, or let's say you have a real estate development kind of a scenario where POC or completed, contract method is a significant, accounting judgment. So those judgments need to be disclosed appropriately in a manner which are elaborate enough for the users to understand, okay, this is something which is subject to judgmental, judgments. For overtime performance obligation, that is POCM, the method, whether it's input method or output net method, is not disclosed. Why depicts transfer is not disclosed. Policy is still written under, so sometimes the companies have still the hangover of IND AS 18, so some of the accounting policies, the wordings of it is still based on risk and rewards and not control based. Revenue was recognized without meeting the criteria set out in IND AS 15. Contract liability movements were not explained adequately. Incorrect measurement of trade receivables. So trade receivables, NEFRA, I think this trade receivables second last and last points come from NEFRA, where they found that the trade receivables have been measured at fair value, which is wrong. Trade receivables should be measured at transaction value, that is under IND AS 115. Incorrect measurement of forward contracts, FVTPL classification of forward contracts was not made. So again, in case of one of the listed companies, NFRA found that it is incorrect accounting policies. Any questions on this? Yes, sir. Ji. Ji. Yes, net book value. It, of course, you need to do a purchase price allocation where whatever consideration you are paid, okay, that you compare, you have to allocate between the fair value of the individual assets and liabilities that you have taken over. So वो fixed asset का जो आपने लिया है उसका fair value भी एक determine करना पड़ेगा, and then there is an allocation process. But the larger question that you are asking is whether gross and accumulated. No, you have to collapse it as a net book value, and based on that only whatever fair value allocation happens as a result of PPA exercise. Yes, yes. So under IND AS 103, when there is a erstwhile, there is a staggered acquisition. There are a few, paragraphs in 103 which deal with such scenario where you have staggered. So you are not acquiring the controlling stake in one go. You have earlier some stake, and eventually you take a controlling interest in that company. In that case, the consideration has to be fair valued at the date of acquisition, and in that case, PPA आपको date of acquisition पे proper this purchase price allocation you have to do on the acquisition date. That is on the date on which you achieve the control, acquire the company. So this requirement of collapsing the gross block and the act depth is it's irrespective of whether the acquired entity was earlier a JV or otherwise. Coming to IND AS 109 or IND AS, the financial instruments package, and again we know for a fact that financial instruments to get those disclosures, everything correct is again sometimes it becomes a task, especially when you are running against the company, the time, etc. Because there are many disclosures, right? You have the financial risk management disclosures, the sensitivity analysis, the contractual liquidity risk, contractual maturity. You have the fair value disclosures, etc. So equity investment shown as cost or amortized cost. You cannot classify equity investments other than investment in subsidiary, associate or JV as at cost or amortized cost. It has to be at fair value, right? So that was one of the fatal flaw. Or fair value designation inconsistent across the notes. Many a times, wherever you are giving in the schedule level or in the disclosure level, you need to give a table or otherwise clearly mentioning what is the measurement basis of the financial assets or financial liabilities. So one will have to make sure that across the financial statements there is no inconsistency when it comes to the measurement basis that you have disclosed. Sometimes you may use fair value through OCI or fair value through P&L interchangeably. Sometimes cost and amortized cost people use interchangeably. So be careful about those terms. Initial recognition policy says that at amortized cost, instead of at fair value plus transaction cost, if not at FVTPL, sorry, I missed the second bullet point, ECL not recorded on doubtful loans or trade receivables, including arbitration or dependent receivables. So some of the times, sometimes the trade receivable or doubtful loans, there is no ECL disclosure. That is, again, in ECL, there is a significant disclosure of the credit risk, of the provision matrix, and again, NFRA has also time and again found out many disclosure deficiency in the ECL of even listed companies. So for example, there is a paragraph in 107 which requires you to give a trade receivable ka buckets, not just the buckets which we gave in Schedule 3, but also the ECL rate, the provision percentage which you use to get to the ECL figure. That needs to be disclosed bucket wise. That sometimes, in fact, many a times companies miss. Interest income by EIR or amortized cost versus FVOCI not split. So interest income can be accrued on amortized cost financial assets as also on FVOCI debt investments. This split many a times companies do miss out on disclosures. Misclassification under IND AS 32. Sometimes the classification on balance sheet or in schedule itself is not correct. So prepaid expenses shown as financial assets, employee benefits payable or leave encashment or other unpaid dividend not presented as financial liabilities. So one has to be very clear with respect to the IND AS 32 requirements with respect to what is a financial asset, and the categorization in the balance sheet and in the schedule has to be very carefully looked into. Sometimes advances to customer, advances to vendors can be wrongfully classified as financial assets, but in fact it is non-financial. Prepaid expenses sometimes shown as financial assets, again that is a wrong kind of classification. Income taxes, tax expense duplicated or misplaced, face of P&L and inside other expenses, no tax effect on OCI items. So OCI items may be deferred tax you will have to create. MAT credit shown as other assets instead of deferred tax. Under IND AS, MAT credit is a deferred tax asset. It's not a other assets or a tax advance. Any questions on income taxes? No. EPS. So the numerator used the total comprehensive income. So formula mein gadbad tha EPS ka. Numerator was picking up the total comprehensive income instead of the PAT as numerator. Only denominators shown, no numerators or reconciliation. So reconciliation, the calculation of EPS needs to be disclosed. Note on cross-referencing was wrong. Face value, there is inconsistency. There's a requirement of disclosing the face value of the shares. So the share capital schedule also has a disclosure of requirement of showing the face value. So make sure that the figures are matching. EPS for discontinued operation not disclosed separately. As I said earlier, कंटिन्यूइंग एंड डिसकंटिन्यूड ऑपरेशन का EPS अलग अलग दिखाने का डिस्क्लोजर रिक्वायरमेंट है, सो दैट हैज़ टू बी डन. Under leases, lease cash flow is not separately shown. So under financing activity, the interest payouts and the principal payouts have to be disclosed separately. So again, this is a very common error that even in some of my clients I come across, that lease payouts जो होता है, they don't bifurcate into in the cash flow statement into principal and interest portion. Total cash outflows for leases not reconciling with cash flow line. So there is a reconciliation requirement where the disclosure requirement is that you reconcile the opening lease balance, lease liability balance with the closing. तो उसमें आपका interest accrued जो आया होगा वो that should match with your P&L figure. The outflow, the payment of leases जो होना चाहिए वो आपके cash flow के figure से tally होना चाहिए. So if there is a mismatch, then these people will catch it. Schedule 3, some of the disclosure shortfalls. Borrowings, lender-wise default period and amounts not disclosed. Trade payables, MSME and not non-MSME, not split on the face. Required MSME disclosures not disclosed. So again, we probably have seen it that ROC has started taking this MSMED disclosures very seriously now, and the interest that is accrued, if there is an outstanding MSME balance, that needs to be disclosed, and if there is no interest accrual, they have started questioning why you not provided for interest liability. Investments quoted, unquoted, and aggregate of impairment not disclosed. Investments not grouped under financial assets on face of the balance sheet. Current tax shown inside other current liabilities instead of current tax liabilities net on face of the balance sheet. Unpaid dividend not shown under other financial liabilities. CSR disclosures missed out. So for example, the amount CSR spent or shortfall in CSR, reasons, nature, any RPT within the CSR spent, any provision movement, those disclosures have not been adequately furnished. Again, CSR disclosures are very important from a ROC's perspective, and they do run a, based on the XBRL that the companies file, they do run a, algorithm on that to identify whether there's a disclosure deficiency or anything, and they do issue notices to the companies for any disclosures, deficiencies or CSR non-compliances. The matter contained in the financial statements, the abstract of a note to the financial statements of a company read as follows: certain balances of trade receivables, loans and advance, trade payables and other liabilities are subject to confirmations or reconciliation. ये दे सकते हैं क्या अभी? नहीं दे सकते, right? So if you have as an auditor not been able to get confirmations or reconciliations of certain balances or related party balances or any balance, earlier many CAs, many firms used to take a position that I'll disclose in the financial statements कि नहीं मिला, it's subject to confirmation. That practice is wrong, because then you either are okay with it, or if you are not okay, you deal with it in your auditor's report as a qualification or EOM or whatever. But merely by giving this disclosure in the financial statements and not dealing with it appropriately in the auditor's report, you are not actually serving any purpose, and this is something that the FRRB and even the NFRA doesn't really like, and this is something which you need to be careful with. ये नोट कभी आना नहीं चाहिए आपके फाइनेंशियल्स में. कैश फ्लो स्टेटमेंट्स, ग्रॉस वर्सेस नेट प्रेजेंटेशन, the bifurcation of financing and investing cash flows presented on net basis. So unless there are certain specific cases which IND AS 7 allows, unless those criteria are met, you cannot present the cash flows on a net basis. It has to be on gross basis. There's a reconciliation which was introduced about 3-4 years back in IND AS 7 by way of an amendment, that you need to reconcile the changes in liabilities from financing activities, meaning whatever borrowings you have in the balance sheet, you need to reconcile that with the cash flows, whatever cash outflows you are showing towards prepayment of borrowings or proceeds of further new borrowings, and all these figures, the opening balances, the closing balances should match with the balance sheet figures. The cash flow figures should match with the figures that have been presented in the cash flow statements. And if there are any other expenses, that is non-cash items like FX or any EIR adjustments, that needs to be also one of the items of the reconciliation. Sometimes it's difficult to get this reconciliation right, but this is something which is required under IND AS 7. Non-cash items not added back, ECL write-downs, write-offs have not been added back for the purpose of cash flow statement. Interest income not removed from operating. OCI remeasurements adjusted in operating. Since the starting point of cash flow statement is the PBT, you cannot have OCI items in cash flow. The moment ऐसा कुछ किया है, मतलब वो बंदे का कैश फ्लो टैली नहीं हो रहा है, दैट्स अ प्लग नंबर. सो उसने वो सिर्फ एक जमा लिया है. सो OCI cannot be part of your cash flow statements. Tax paid not shown separately. Increase in service concession receivable pushed to investing instead of operating. Related party transactions, and this is again as you know NFRA का एक focus point हो चुका है RPTs. So please double triple check whether the disclosures of RPT in case of listed companies or listed clients are compliant with the requirements of IND AS 24. So inadequate disclosures of RPT, the matter contained in the financial statements, interest receivable from a related party or advances to related party were mentioned in the notes to financial statements on other current financial assets and other current assets respectively. Party-wise details of material RPTs not disclosed. Aggregated reporting that obscures significant transactions. Non-disclosure of guarantee. So sometimes if there are guarantees between companies, or in fact guarantees that were given by the KMPs or promoters on behalf of the company, that also needs to be disclosed narratively at least, right? So that is something which NFRA had also one of the earlier orders pointed out. Incomplete disclosure of compensation of KMPs, missing disclosure of terms, conditions and nature. So the narrative disclosure, the qualitative disclosure that the standard lays down is you don't just disclose the figures, whatever terms of dealing with the RPTs, that also need to be disclosed. So for example, whether the credit period was the same as non-RPTs, so those kind of disclosures also need to be disclosed. So that was about it. Maybe 5-10 minutes we can have some question if you guys have any, but common errors in financial statements is otherwise, most of us know that these are common errors, but in the heat of the moment, because of paucity of time and paucity of resources, sometimes we do at the time of finalization of the financial statements, we do tend to sometimes overlook on these disclosures. But the idea was, since we are in March and now we will be leading into the finalization season, so this session was, the objective was to basically refresh के क्या हमने take care करना चाहिए while closing the financial statements, etc. So please be you have a question? Ma'am, can you speak up a little bit? So many a times in some of the better companies, larger companies, you will find in RPT note, you know, you will find a narrative, couple of lines you will find that RPT, the related party transactions, are at the same terms and conditions as in case of other, you know, transactions. Meaning that, and even in arm's length testing, if you look at the, you know, LODR requirements for arm's length testing, somewhere they have clarified that it's not just about pricing. It's also about कि आपने RPT करा है, भले ही price is at arm's length, but if the credit period, for example, is different as against a non-RPT, then also the audit committee, while approving, it has to approve it. So here the importance of this disclosure is to basically disclose that RPTs, whether they are at the same terms as in case of other you know, non-RPT transactions, or are they at different terms. Generally what happens, लोग एक one liner लिख लेते हैं कि all RPTs are at same terms and trading conditions as in case of other transactions. But yeah, you're right. Generally इसका कुछ deviation रहा तो it's very rare to come across in the financial statements. But yeah, I don't know how many you know, companies do evaluate this disclosure requirement and you know, capture it properly in the financial statement. But point is कि ये एक देखना चाहिए हमने अगर कुछ uniform. Yes, yes. Yeah, terms means credit terms or कुछ advance कुछ वो हुआ है क्या, things like that. Yes, sir. In operating segment? Yes.
So generally in non-current asset we give all this PP and all those assets.
Yes.
And along with that, capital advances could be there, and non-current tax asset is also there.
Yes.
So standard says that deferred tax asset and financial instrument you can remove, and all those balance you need to consider for this addition to NC purpose.
Correct.
So my question is this non-current tax balance, that is generally not similar to capex sort of activity. That is a fluctuating thing. In 1 year it can become a tax.
It may not be perhaps attributed to a specific segment. It is at an entity level, but not at a segment level.
And segment level also. And what I'm trying to say that in 1 year, entity can have a tax liability which could be a current tax liability. And
things may change. Correct.
So this should, since standard does not give this exemption to remove it, can we?
See, basically, IND AS 108 does not prescribe anything. What all IND AS 108 says is that if you are giving segment assets and segment liabilities, so you give that only if the CODM looks at the segments that way, right? So see, IND AS 108, apart from the entity-wide disclosures, which is based on the geography, the revenue, etc., it does not prescribe any specific format for the segment disclosure. It says that you need to disclose the segment information based on whatever CODM reviews for the monitoring and allocation of resources into various segments. So therefore, segment asset, segment liability का जो disclosure है, that you would give only if the CODM looks at it. And if you are giving it, CODM, whether they break up the tax asset or tax liability into you know, segments, generally CODM wouldn't care, and it would, as for the reasons that you mentioned, it would look at it on a overall entity-wide basis. So in my view, if you are giving segment assets and liabilities, and if the CODM based ही है, तो you should not include tax asset as a part of your segment you know, assets. And in fact, in AS, in the accounting standards, segment assets and liabilities do not include any tax asset and tax liabilities. So drawing an analogy from that, I think वो similarly ही होना चाहिए in my view. Does it answer your question? Okay, great. Yeah, any other questions? Okay, so looks like there are no further questions. So that's all about, that's all from my side. I thank you for having, both the sessions very interactive, and I thank the WRC leadership to give me the opportunity to present, to present these sessions. Thank you, everyone.